Hello and welcome, everyone. It is Wednesday, February 21st, and this is the War Room. If you don't know me, I'm AgYield's marketing manager and everyone's favorite backup host, Jack Coakley, filling in for Dan yet again today. Excited to be back. As always, you know the deal. Join in on the discussion. Leave a comment. Reach out to us at info@agyield.com. We're always happy to hear you, answer some questions, whatever the case may be. Let's jump right into it. Johnny, I know you got the overnight numbers, so I'll kick it over to you.
Yes, sir. Thanks, Jack. Good morning, everyone. We had March corn down 2 at 416 3/4. Dees corn down 2.5 at 460 1/2, and March beans down 6 3/4, 1172 1/4. Nove beans were down 6 3/4 at 1151 last, and March wheat was down 3 3/4, 579 last. Stock market's down a little bit here today. So yeah, we'll see if we get any follow through again. So
great stuff, Johnny. Way better than when Dan does it. You just have a natural knack for reading off the numbers. Enough rambling from me. No problem. We'll jump over to Dustin with some of his thoughts.
Yeah, thanks, Jack. So critical week for the options. We've got March corn, March CBOT products will go off the board on Friday, the 23rd. And we've obviously had a very long and aggressive sell-off for a lot of these products. So corn, for example, a lot of those put strikes have gone down deep into the money. As of this moment, as of yesterday's open interest report, we have 94,400 puts that are in the money as of today's price right now, and only 734 calls that are in the money. So the average put strike is just above 450, about 453. When you think about open interest, like that's almost a third of open interest right now going into option expiration on Friday. There could be some of those option holders that don't actually want the position, and if they sell out of it, that would actually be a net buy from the market. So something to kind of consider. It's been kind of doom and gloom going into first notice day. We've talked a lot about basis only contracts. Just one devil's advocate to that entire argument is that about a third of contracts are open in the money puts right now going into Friday. So it could be a very interesting settle out of how those position holders change over the next 2 days.
No, that's great stuff. I appreciate that. Any additional comments on top of that before I shoot it over to Ben?
Yeah, I would add to that. It is definitely a unique situation. We haven't seen that in a long time, and we've seen certain ones, especially in beans, where November contract, you're deep in the money and they like to rally, especially during that crop insurance time. Take a lot of those guys out of the money. To your point, Dustin, interesting. It's been a unique year, as we've talked about a lot. Just the seasonality of this break, the depth of the break, the consistency of it. Even the December options, we had a similar type setup, not maybe to the degree that we see in the March, and it kind of brushed that off and just kept breaking. Which maybe should have been a sign. Yeah, it's difficult. You struggle all day to get up 4 cents, and then you're down 3 overnight. So you're certainly still fighting the momentum, which is down. And they're going to keep adding on until they don't get away with it. So I agree. I think this can be a really important Friday, like this week and next week, for a lot of different. There's so many things coming at us, and then with you're basically 30 days from a major crop report. So it's going to be an interesting. We might be a little more two-sided, hopefully the next 30 days than we have been the last 30.
Yeah, very. That's, when you think about option sellers versus option buyers, a lot of times the sellers might not actually be the position holder. They're going delta neutral on that, right? So they've already sold their futures against those puts on the way down. So as you're going down into the money, if the majority of the position holders are long option holders, there's actually a market selling to stay on top of that delta position on the way down, and that could have helped drive the price down in the process. And it comes back down to, well, are these position holders a bunch of producers that are about to actually deliver against these long puts that turn into sales, or are they position holders that are more apt to just sell out of it because they don't really want to be short at these levels? or sell out of the put, which would also be the same thing as buying the futures at this point.
Mhm.
So, taking people out of the money, a lot of times the position holders take themselves out of the money because the first ones out are the ones that start the move.
Mm-hmm.
So we'll see. It may be a wrong premise, like you said. It could be that the position of the undersold grower that's going to the market over the next month or next 2 weeks, that might be a bigger position. We'll have to
Yeah, you would
watch.
think if the long put holder was the producer, especially where the strike levels are, they'd happily take it at this point. They're so underwater that which could also, it could clean up the market too. If those turn into futures and they get delivered, maybe that's where they get caught up on sales. So it doesn't necessarily have to be, bearish either.
Right. Exactly.
Well,
And yeah. So go ahead, Ben. Actually, good point.
I was just going to say as well, I think that's a really good perspective of how the options play into the futures. And not that it would happen on this one, because we do have still a fundamentally bearish market, is that if we were to reverse from people who are long the puts who haven't covered, you mentioned that the people who are shorted are definitely managing their delta risk much closer to the chest than a person who's long. That can turn on them as well, because they now have to remanage that delta risk on the way back up. And when you get into an expiration type scenario, you're talking about really just big futures positions.
Yeah, deltas grow quite fast. Yeah,
Yep.
when we're in the money like this. The one thing I would say too yesterday is we actually saw spreads continue to widen yesterday. So March D's got to its widest point. July D's got to its widest point. So by all indication, the market's still focused on bushels that are coming to the market more than likely in the near term. But just a little bit of focus shift toward maybe a devil's advocate to that argument for the next 2 days, especially going into option expiration. Justin said, hopefully it's more of a two-sided market. We would love to see the market go up at this point too. That's going to help the health of the grower. But we're cautiously optimistic.
No, certainly. That's really good stuff, guys. Ben, you mentioned before we jumped on here that you had some maybe some technical stuff to.
I kind of adds in on the tails of what Justin had mentioned, that corn had been in just a very methodical move lower. And in our early discussions, John brought up the fact that March corn has not settled above its 20-day moving average since sometime in December 5th, I believe, December 7th.
March beans.
March corn is the same. So that's what I'm looking at here. So just a really methodical grind lower. The 20-day moving average today comes in at 435.5, which is 19 cents above where we're trading. And the 200-day average is all the way up at 499. And these kind of markets have really, I think, beaten a lot of people who are friendly into submission, and certainly have beaten the producer down. And as we head into first notice day, the delivery aspect of it becomes real. And I think a lot of it gets cleaned up between now and next Tuesday. At least the short-term pressure. It doesn't mean that we're going to rally $1, but we should maybe take the boot off the throat here for a little bit. So we're well below major moving averages. The 20-day, 25-day, however you want to look at it, have been stalwarts of a methodical grind lower. And we'll see as we get a little bit closer here, options expiration, as well as first placement and first notice day. So I think that there's a lot of interesting position changes that are going to take place over the next week.
Thanks for that, Ben.
Yep.
Last but certainly not least, let's shoot over to Ryland to talk a little bit about livestock.
Hey, how's it going? Kind of a mixed bag yesterday. We were a little bit mixed on the live cattle side. Feeders did notch a new high for the move, so that's still continuing. Looks like open interest was also up in both places, and definitely a pretty big up in the on the live side of things. So cash has really been slow to develop here overall. Just a little bit of trade in Iowa, but definitely not enough to really tell us if we're higher or lower. But there's a little bit of a sense right now that we could see a bit of a back off here, just if Packers are really going to reduce the size of slaughters. So it's a little bit of a concern just to the pricing structure on the board, especially with the premium that's priced in. So we're likely to still see some more deliveries here if cash is trading a lot lower and the board continues to see this premium. But I think one of the more shocking things to note is that the Reuters poll came out for the cattle on feed report that's due out on Friday with placements expected at 87.7%. So that's like a 12% decline. So that number is actually printed. It's hard to disagree with how tight everything's going to be here. Just overall, it's about 1.69, 1.7 million head placements. So it just kind of reinforces, I think, the pricing structure into direction, which is just how tight we are right now. And we're just kind of going hand to mouth, and Packers are dealing with red ink on their margins. So it seems like we're just waiting to see these numbers and then just trade accordingly. But it still seems like we're really going to follow the nearby cash. So on the hog side of things, we've had this melt up for 3 days. The market's been rallying, but we've just not been able to really hold our daily gains. And there was a pretty big down in commitment yesterday. About 5,800 contracts came out. So it looks like the funds are probably starting to cut back a little bit. So could see a little bit of a down here, especially just because bellies were down $8 last night. So the meat's starting to weaken up. I mean, seasonally, we should still trend higher, but I think it's good just to, maybe take advantage of this rally that we're on and maybe look to get a little bit more coverage here from the producer side of the market. But that's all I got, Jack. Appreciate it.
Excellent. Well, we just had a question come through. Appreciate the question and anything that gets you into the discussion here. I'm going to shoot this over to Dustin. Any thoughts on basis?
Yeah, it's a good question. We are, I think that we're looking at still in the East, a pretty soft basis. Futures are obviously trying to do a lot of that work. We have not been very competitive. Ukraine's been undercutting us. We do have a drier forecast for Brazil right now for safrinha corn. So I think one of the better things that could happen for the market would be if they have any sort of an issue. They're looking at potential for another huge crop, second season corn crop by July. So the market feels comfortable with that. Sometime in April, May, it's going to probably be a difficult thing for us, going into June, July. But exports have been kind of poor, and ethanol margins have remained. And, we're looking at crude oil kind of breaching $80 a barrel yesterday or close to it. So I think there should still be some pockets of domestic market strength here and there on basis. I just think that when we're talking about a 2.4 billion bushel carryout, one of the largest ones we've had in a long time as percentage of stocks to use, we should not expect basis to do anything like it's been the last couple of years in our deficits. So the other thing to consider for basis too is we have a decent carry from March to July, for example, but we're going to eat a lot of that up in interest for those that still have 8% operating notes to pay down. So I don't think it's that clear that, carrying it to July and then expecting a basis pop is going to be an easy outcome. But at the same time, we are, we're chugging along on use here domestically as much as we can. And whenever those things pop up, especially during the early planting time frame, look for those basis deals and try to probably unload it at that point.
I would just add to that, talking to processors in the East, they're fairly well covered. There's no reason for them not to be. On a meeting yesterday, someone shared with us a stat that there were 65 million more bushels of corn in Ohio year over year. And when you look at rail markets, they're flat all the way out. So it doesn't send a message that there's hope for a lot of export going out to July. And river bids on the Ohio River have been very soft. So corn is moving. It's satiating the need for the processor. Thankfully, ethanol margins are good, and they're grinding at full rate. So I think where we've had this big break, a lot of growers thought that it would be made up with basis adjustments, and that just has not been the case. I do think that if we see a significant flat price rally, we could actually see basis get worse from here.
No, that's
Yeah, I was gonna add to that real quick. Yeah, I think the flat price directed here, you know, and it depends on how much of this producer long we kind of clean up. You know, so all these things I think are the next 60 days, to Dustin's point too. If we've been undercut by everybody on export market, you know, now the river levels have started coming up. Export inspections have picked up in corn and beans. South American premiums have increased for soybeans. So a lot's going to depend on that safrinha crop. If we start cutting prospects there, I think we could have a summer export market. So that's going to be really, I think, what helps drive any basis appreciation. If we do, it's going to have to come from the export market.
That and I don't want to get out in front of any weather scenario, but having been in the East in 2019, if there is some perception of reduced production, even if it's early in May, late April, May from rain, I think you will still see a grower get even more stubborn and hold on to bushels. That to me would be an outlier where you might see basis perk up maybe a little more than people would think. But that could create a problem over the horizon if everything works out into June, July, which is where people think they're going to get paid on basis. So a lot of variables moving forward, but that would be the one outlier where I think people would be reluctant. And I do think that a lot of the on-farm corn that's out there is not sitting against hedges, which we kind of know that because if you were going to deliver grain, you would have delivered it against hedges in hopes of later price appreciation. So I do think that we become very vulnerable to on basis to price rallies short of some sort of perceived crop disruption.
No, that's great stuff, guys. Thanks for that. Looks like we just hit the open, so let's go to John with the numbers. Is he ready?
Sure, thanks, Jack. March corn down 2.5, and you got D's corn down 2 3/4, 460 1/4. March beans are 11.69 down 10, and Nove beans down 9 1/4, 11.48 1/2. And then you also have March wheat at 5.77 down 5 3/4. Stocks are getting hit a little bit. Crude's unchanged, and so is the dollar. So
thanks for that. Again, we're always streaming live here on YouTube, X, and Facebook every morning at 8:15 a.m. Every morning the markets are open. Any last parting shots from anyone here? No? Well, thanks again for everyone for tuning in. The great discussion today, guys. We look forward to future discussions in the future, and we'll talk to you very soon. Have a great day.
Thank you.
Thanks, Jack.